Welcome everyone to today's webinar, co-hosted by Quantifi and Kauri Solutions. My name is Sakvir Chima, Director of Marketing at Quantifi. This webinar looks at whether, as intended, FRTB will help strengthen market risk practices. As many of you will know, in July 2015, the Basel Committee proposed the FRTB-CVA framework, which replaces the current CVA risk capital calculations. 6 months later, it published the final rule of the FRTB framework, designed to address the undercapitalisation of trading book exposures witnessed during the financial crisis. Today's webinar, presented by Dmitry Pugachevsky, Director of Research at Quantifi, and Vlad Ender, Managing Director at Kauri Solutions, explores both these frameworks in their historical context and takes an in-depth look at the challenges and implications of FRTB. I will now pass you on to Vlad.
Broadly speaking, we can split FRTB into a qualitative and quantitative parts. On the qualitative side, BCBS wants to strengthen the distinction between the trading and banking book. Current rules are not very prescriptive on this, and it was used, or the regulators would say misused, during the GFC to optimize banks' capital. The new rules are very prescriptive, what should be in a trading and what in banking book, and any exception to that must be explicitly agreed by the regulator. Also, moving positions between banking and trading, which was common during the GFC, will become harder on the FRTB. Moreover, any such move will leave the capital unchanged, so you won't be able to benefit from moving the positions anymore. There are also further rules on internal risk transfers, trading definitions, governance, and overall structure. For example, banks used to have desk co-heads, and that's not going to be possible anymore. But while the qualitative part has impact, I suspect most of you are more interested in the new quantitative parts, the standardized approach and the internal model approach. So the standardized approach is, as the name says, the standardized and a highly prescriptive calculation of capital charge. When I say highly prescriptive and standardized, about half of the pages, about 40 pages in the 80 pages BCBS document, cover the standardized approach, so it's clearly a new and a fundamental part of the FRTB. I believe that it is important to describe some of the goals that BCBS had in mind coming up with standardized approach before I sort of get to the parts of it. One of those goals was that it would have to be a credible fallback from IMA. How many of you now work at an institution that actually uses IMA but could drop it overnight for a capital calculation? With standardized approach being a viable fallback, the IMA eligibility rules can also change from the current blanket approval to a desk level granularity, where desks can move between IMA and standardized capital calculation virtually overnight. Another goal for standardized approach was to increase the comparability of the risk results. IMAs are generally fairly complex beasts where a number of different assumptions can be made. And the studies found that the results for the same portfolio can vary quite widely across banks. The idea behind the new SA is that it should be the same for everyone, and the same portfolio should produce very similar numbers. To support both of those goals, FRTB also mandates that all institutions must calculate their capital with SA, regardless of whether they have IMA approval or not. Of course, if your desk is IMA eligible and has IMA approval, you can use the IMA capital, but you still have to calculate the SA number regardless of that. So what is this then standardized approach? It's made of 3 parts: enhanced delta plus, which is effectively a sensitivity-based analytical bar, default risk charge, which covers jump to default risk, and residual risk add-on, everything else, a bit of a catch all for all the other risks, and I'll go through all of them now in a bit more detail. Starting with Enhanced Delta Plus, EDP. So as I said, EDP is in effect an analytical VAR calculation which uses delta, vega, and curvature risks. It calculates these for prescribed risk factors across 7 different risk classes. Each class is then split down into more risk buckets. For example, in commodities, metals and softs would be different buckets. In interest rates, all the currencies are different buckets, and so on and so forth. Risk weights are attached to these risk factors directly or to buckets of risk factors. EDP then aggregates these risk factors in buckets and between the buckets using variance-like formula, which uses prescribed inter-risk factor and inter-bucket correlations to account for diversification. This correlation can be modified by applying low or higher correlation multipliers to effectively stress the correlations, and the worst result across those stressed correlation results is then used. There is no diversification or hedging allowed between risk classes or between risks. By risks I mean your vega, delta, and curvature, which obviously can be quite punishing. If you are familiar with ISDA-SIM margining, then EDP is very, very similar. In fact, it looks to me like ISDA-SIM took the EDP and modified it a bit to get something very similar. The other two parts are the default risk charge and the residual risk add-on. The DRC is intended to capture the jump to default risk, both for equity and credit. So, for example, you can now use short equity position to offset long credit exposure. Again, it's fairly prescriptive. It has defined LGDs for instruments, buckets, and the ways to calculate hedging effects in those buckets. Last charge is residual risk. It sounds simple. It's a multiplier applied to a notional of a trade, which has risk not captured in NDP or default risk charge. Those could be exotic risk like longevity, or less exotic risk, for example, binaries or prepayment risk. As I said, it sounds simple, but it actually can be fairly ambiguous, and it remains to be seen how regulators and markets will approach it. For example, for a binary, technically you don't need any notional, or you can have whatever notional you like. So which one do you apply? For balance guaranteed swap, you will have two different FX notionals, with neither of them might be your reporting currency notional, and you might have roller coaster notionals. So again, which notional and at which time do you apply? It's not necessarily clear from the regulation. I could see how some products could be restructured or innovated, if you want to call it that, to attract a lower residual risk charge than they do now. And this could be especially important in the securitization space, because securitization capital can now be calculated only using the standardized approach charge. You cannot use internal model for calculating the market risk capital for securitization. So that's it for standardized approach, and we can move on the internal model approach. That's made up of three parts, which roughly correspond to the standardized approach parts we discussed before. There is a bit of difference, but that is that the risk factors are not prescribed. They are what you find your risk factors to be. That said, they are split into two wide groups: modelable risk factors and non-modelable risk factors. What those non-modelable risk factors are, I'll get to a bit later. IMCC is the capital charge for modelable risk factors. It's similar to today's VAR or SVAR calculation. It shocks risk factors and generates a number of scenarios, except that instead of VAR, expected shortfall is calculated on those scenarios, and the resulting numbers are aggregated to get you modelable risk factor capital charge. Capital for the non-modelable risk factors is calculated using stress scenarios, which are added on the top of this without any diversification. The last is the default risk charge, which again captures the jump to default risk. SA, standardized approach, is prescribed by the regulator and everyone has to do it. IMA you can do only at the leisure of your regulator, so you have to apply to get it, but then also you have to satisfy eligibility tests, which are run on a monthly basis, and I'll cover those as well. As I said, IMCC is the modelable risk capital charge. It's based on aggregating the expected shortfall across a number of scenarios. Scenarios are defined by inclusion of risk factors to shock, where the inclusion is governed by risk classes and liquidity horizon, and also by time, either the current period, last 12 months, or a stressed period, worst 12 months for your portfolio since 2007. Risk classes are pretty much what you would expect: interest rate, FX, credit spreads, and so on. Liquidity horizon is something new introduced by FRTB. Under the current regulation, your portfolio has an expected holding period of 10 days, and most institutions calculate it by simply scaling the one-day holding period risk number. Well, in GFC, we found that 10 days is a fairly optimistic period for liquidating parts of the portfolio, and liquidity horizons is something which is supposed to capture the risk and recognize this. So your scenario starts with all the risk factors, and then you generate new scenarios by removing the most liquid ones, and so on and so forth. And that helps to account for the risk of not being liquidate your positions promptly. Well, as you can probably imagine that this introduces problems on your own. What if you have a long liquidity horizon risk factor which is hedged by a short liquidity horizon instruments? Well, as you generate the scenarios, you remove the short liquidity horizon instruments and you get extra risk. So if you think about, for example, a interest rate options book, liquidity horizon for interest rate wall is 60 days, but for major currencies, interest rate liquidity horizon is just 10 days. So if you were theoretically to delta hedge an option book using nothing else but delta, that would be fairly flat on your 10 days liquidity horizon. But when you move to 60-day liquidity horizon, you drop all of those delta generating instruments and you get a fairly massive unhedged position. There are ways to deal with this, but it goes beyond the scope of this webinar. As you can also guess now, all of the above means that there is a potentially large number of scenarios that can be generated by this approach. In fact, in extremis, there is 63 different scenarios that you might have to calculate to add up to the resulting capital. That means that complex portfolio must be approached in a smarter way than it is today, or you might have to deploy considerable brute force to calculate actually your capital. The other two parts to the IMA are, as I said, default risk charge and non-volatile risk factors. So default risk charge, as I said, accounts for jump to default risk, and it's VaR-based, and again includes equities. Interesting part on this, amongst the other things, is that the regulation explicitly prohibits the use of market-based probabilities of default. If you have a IRB approval for credit, then you should use those probability of defaults. So you have to use historical probability of defaults, not the market risk neutral one for your DRC calculations. Non-modelable risk factors are something new in FRTB, and I think it's one of the trickier aspects of FRTB. Basically, any risk factor which is not observable enough is automatically classed as unmodelable. I think that the use of word modelable is a bit misnomer, but that's what BCB has decided to go with, so that's what we'll have to live with. What it means in practice is that for some risk factors, we cannot get good enough data series. The rules say that to be observable, you have to have at least 24 data points in a year, and none of those can be more than a month apart. That sounds simple, but it gets considerably more tricky when you start looking at what is meant by observation and what actually often happens in the market. So observation is a price at which an instrument or a product from which you derive your risk factor traded, or a firm quote to trade. You can get those from a third party, but it must be, the third party must be able to agree to provide evidence to substantiate this, substantiate that they either traded or that they had a firm quote. So we can't use your Reuters or Bloomberg screen prices anymore, because those might not be something that something actually traded on. And it might prove hard at times to persuade the third party to give you those prices, because they would be effectively giving you pricing information as a competitor. And they might not wish to do so because, well, amongst the other things, if you are then hit by higher capital charges because you have to treat it as an NMRF, that might be to their advantage. On the other hand, there are also good reasons why they might wish to provide this to you, so we will have to see where the market goes with this. You may also think here that the number of observation rules might be a bit harder to satisfy than the month's gap. That actually might not be so. There are estimates that something like 90% of all the single name CDSs might fall under the non-modulable risk factors, simply because those are often traded by a few market makers. And when those market makers, when the traders go on a holiday during the summertime or around Christmas, not much activity sort of is in the market, so it can easily hit the 30 days period. Also, I saw a paper just recently which tried to look at it from purely statistical perspective, modeling the arrival rates at which you would get some reasonable chances of not falling under the NMRF framework. And you need something like 50 to 60 observation a year, or 50 to 60 random arrivals of a price a year, which is one a week, to get better than even chance of not having a month's gap between two prices. So it might prove to be quite a challenge to any FRTB implementation. Well, as I said, unlike standardized approach, you can use IMA only at the leisure of your regulator, and the eligibility rules are changing. First, of course, you have to satisfy the regulator that you can do it at all, but then the eligibility rules that you have to satisfy as running the process are changing quite a bit. Currently, backtesting is used to ensure that your internal model is valid and working, and if it's not, you get capital multipliers. In theory, the regulator can revoke your internal model. In practice, it would likely kill the bank, so they are not going to do it. With FRTB approach, where everyone has standardized approach mandated, it is much easier to do so because you need to calculate a standardized approach capital regardless, and you can take much more granular approach to forcing something on the standardized approach capital than everything at once. So there are now two eligibility tests, backtesting, which remains, and a P&L attribution test. The P&L attribution test is basically reconciliation between your risk models and the data used to feed your risk models, and the models you use to generate your P&L and the data you use to generate your P&L. So those have to be satisfied to a good level for you to actually be able to use the IMA. BCBS, as a part of the quantitative impact study in 2015, asked banks to run some of these P&L tests as well, and the numbers weren't very encouraging. If I remember it right, almost 60% of desks failed those P&L tests over the horizon of 6 months. So that means that this P&L reconciliation is likely going to be a significant challenge. Which gets me to the challenges of the FRTB implementation. The three major ones I would name are the IMA eligibility tests I just spoke about, non-modulable risk factors, and the IT infrastructure. How much these challenges will or won't impact the institution very much depends on the business strategy. Do you want to provide complex products or just simple ones? How many asset classes do you want to trade? What I like to say here is that the complexity costs capital. The more complex your business, the more capital will FRTB require. In my opinion, this is a feature, not a bug. BCBS wants to punish complexity. If we go back to non-modulable risk factors, the more risk factors you have, statistically speaking, the more NMRFs you are likely to have and more extra capital you're going to need. The infrastructure to identify, monitor, and process on NMRFs is also not going to be trivial to build and run. I mentioned that handling the number of scenarios required by the IMCC expected shortfall calculation is large, and because the new rules require that the optionality and curvature is captured better, that means that Monte Carlo based on sensitivities may not now be the best method to approach your calculations. On the other hand, if you go with a historical simulation full revaluation model, that again might not be the best because it can get very expensive computationally quickly. So it depends what your infrastructure is and what it can handle, and again what your business strategy requires for it to be able to handle. I covered the eligibility test, so let's just say there that I see some challenges in system reconciliations, data reconciliation, interfaces and processes. I will also mention here that I believe the standardized approach will put much higher demands on data quality standards and enrichment, because you will need to use those to identify your risk factors and bucket them appropriately. I started by saying I would try to show you that the fundamental in the name was justified, so I believe what I just went through makes it fairly clear. I didn't cover the CVA part of it at all, so I'll leave that for Dmitry to do so now.
Okay, thank you, Vlad. Hello, everyone. If I may borrow from Monty Python, and now for something completely different. What Vlad described was the FRTB framework for market risk. And now we will talk about CCR, counterparty credit risk. Actually, it used to be completely different, but now regulators try to bridge these two frameworks, and we will talk about this. But let's first start with Basel II, which in 2006 required banks to set aside capital to cover losses due to counterparty defaults. These capital charges are defined in terms of RWAs, risk-weighted assets, and they rely on the notion of exposure at default, AD. So AD currently can be calculated in one of three ways: CM, current exposure method, SM, standardized method, and IMM, internal model method. The first two, CM and SM, will be replaced by SACCR. Actually, BCBS designated 2017 as the, or even January 2017 as a mandatory date for introduction of SACCR, but we believe it will be started implemented later, depending on local regulators. SACCR retains main characteristic of CM and SM. It's also based on replacement cost and PFE, but it has better recognition of collateral in AD calculation. It has notion of market price of risk, MPOR, and it has better recognition of netting within hedging sets. That was Basel II, and that was capital charges, CCR capital charges. But what happened during financial crisis, banks' losses happened mostly not due to counterparty defaults, but due to CVA moves by estimates of Basel BCBS. 1/3 of losses came from defaults and 2/3 came from CVA moves. CVA, it's probably everyone knows by this time, it's credit valuation adjustments, which banks have actually started putting on their balance sheets in 2000s. And these are losses to the bank, and they depend on counterparty credit spread and on exposure. And during crisis, of course, counterparty spreads widened, and exposures, which depend on volatility, also increased because of increasing volatility, and that led to the CVA increasing and to bank losses. So Basel III in December 2010 and finalized in June 2011 introduced new capital charge aimed to mitigate this CVA volatility. This CVA credit risk charge can be currently calculated using either standard formula or advanced formula. And in July 2015, as was mentioned, BCBS described new CVA framework, which consists of basic approach and originally two FRTB approaches, but later that was reduced to one. I will mention again this later. So let's talk about the current and future approaches. BCBS didn't put any concrete date on implementation of new FRTB framework or a new CVA framework, but everyone kind of should be aware of this, and that's what we try to do now to make everyone aware. So standardized formula, current standardized formula is simplified, formula-based, and in absence of CVA hedges, and only credit hedges were allowed in original CVA capital charges framework. It looks suspiciously as 99% 1 year VAR for normal distributions because of this 2.33 coefficient. And also, if you analyze terms under square root, you will basically, this implies that correlation between all the components is 25%. So it looks like parametric VAR, and each component consists of product of exposure at default, AD, effective maturity, M, and risky weight, W. Risky weight was depending on rating of the table, was depending on the rating of the counterparty. So it started for 0.7% and going to 10%. So let's now, yeah, maybe I have to mention also what advanced approach 3% 1 year, and that requires basically to have IMA model for AD calculation, and again, it's out of the scope of this presentation. But for these were current approaches. Now, if we switch to which were proposed in July 2015, approach BA-CVA is again formula-based. It looks like standardized for standard formula for current CVA capital charges, but there are a couple of important differences. First of all, the coefficient in front of the square root now looks like 1.5 divided by alpha, where alpha is the scaling factor currently set at 1.4, and it's designed to compensate for alpha, which is a part of exposure at default calculations. But probably they're now based not only on rating but also on sector, and now they're pretty high risky weight. Risky weight was starting at 0.7%, so it's a big difference. Oops, sorry. And described by, maybe I will mention here what happened with the third approach, or with the second FRTB approach, IMA CVA. It was proposed in July 2015. It was included in QIS in February 2016, and then regulators decided to eliminate it completely in March 2016, maybe probably based on this QIS. So now there is only one FRTB CVA approach, SA-CVA. And as I said, SA-CVA is an attempt by regulators to bridge this difference between counterparty risk and market risk. Because CVA, as everyone already realized, became part of the pricing, it wasn't clear why it should be treated very differently from market risk. So this is like, as I said, an attempt to bring CVA a capital charge, or to basically to apply to CVA capital charge FRTB framework. To use SA-CVA, banks has to follow following requirements. The calculation of CVA scenarios should comply with general principles for the calculation of CVA. there should exist a methodology for approximating the credit spreads of liquid counterparties. There should exist a dedicated CVA risk management function and control unit. In other words, qualifying banks need to follow general principle to calculate regulatory CVA in line with the FRTB framework. Another important difference is that now not only credit hedges but also market risk hedges are allowed. And in absence of hedges, regulatory capital looks like this. So total capital charge is a combination of bucketed capital charges, which are combined using inter-bucket correlation gamma. And each bucketed capital charge is basically based on this formula, where WS is a weighted CVA sensitivity. I have to mention here that this sensitivity is more like scenario, like volatility move 1% or FX moves relatively 1% and delta and so on. And rho are correlation, intra-bucket correlation. So approach which have a lot of similarities because SACVA was based on SATB, but there are also this SACVA is done in addition to Basel II RWAs, which take into account default risk. SACVA doesn't account for default risk. Also, regulators basically recognize that calculating of CVA sensitivities or CVA scenarios can be pretty slow. Granularity of supervisory market factors was reduced in most cases, and gamma was excluded from this approach, so there is no curvature analysis. But to compensate for this, aggregation of risk in SACVA is more conservative than in SATB. And finally, the extra asset class was introduced. This is the counterparty credit spreads, class of counterparty credit spreads, which retain full granularity of deltas but no vega. Immediately after these guidelines for new CVA framework were published in July 2015, the question, what's the impact of this new regulation? How big will be this impact? We started running tests, and later we produced Define, where we look at some sample portfolios, interest rate swaps. Actually, in the paper we also look at cross-currency swaps, at the money, in the money, out of the money, and very important is collateralization. So we looked at several cases of collateralization. Results for interest are colored by what you can immediately see that difference between current, basically we look at current standardized formula and BACVA and SACVA. And difference is really striking. Just for most kind of popular trades at the money interest rate swap with the financial counterparty, triple B counterparty, so it's investment grade, the capital charge jumped from 4.7 million. This is for notional 100 million. I try to avoid the word huge, but this is striking difference, 17 times. And to explain this, we have to remember that first risky weight changed for when you calculate exposure at default. When you calculate BACVA formula, it's now 10. It's to some difference in contributor to this difference is that exposure at default, and this contributed total will be like 17 times. But just comparing, then both BA and CVA are higher than current capital charges, and BA-CVA is always higher than SA-CVA for CSA or no CSA. But what's very important is that when we have collateral, then difference for SA-CVA reduction of capital charge is extremely significant. So collateralization is very favorable for SA-CVA. So it just reduces, see, like 15 times maybe. So that's while for current capital charges, there is no difference unless it's in the money into account. And for BA-CVA, this collateralization has some impact, but much lower impact than for SA-CVA. So looking at this, one CVA should be the way for banks to calculate capital charges with collateralization and with implementing of is basically full revolve since to optimize general calculation. And one can use trading parallelization, pricer, and implement like simpler interpolation and cash flow optimization. One can use optimal selection of simulation dates, use maybe trade-based days. In some cases, semi-analytical solution is possible. For CVA sensitivities or scenarios, one can apply some additional tricks. For example, utilizing dependency graph to analyze which trades and risk drivers are not subject to sensitivity shifts, and then this can be stored and reused, not recalculated. Another efficient method is bucketing, shifting several rates simultaneously instead of individually, and actually regulators require bucketed scenarios, and they don't require shifting any input to the engine. Alternative methodologies often mentioned are AD, joint algorithmic differentiation, but in this case we don't think it's optimal because AD deal mostly with instantaneous sensitivities for all inputs, and here we have pre-specified scenarios, bucketed scenarios, and actually not clear if regulators even allow using ADs for this SA-CVA calculations. And to conclude the whole presentation for both market risk and for CVA FRTB, what we think is that FRTB is anticipated to have a significant impact on capital, modeling methodology, and IT complexity. Banks will be forced to rethink their operating models and risk technology architecture. There will be a requirement to monitor SA capital in addition to IMA. SA-CVA proves to be a much more attractive methodology for calculating capital charges, and it requires full evaluation tool and official calculations. Collateralization and active management of XVA become more important for reducing capital charge, and to achieve fast, accurate, and consistent calculations, banks will need a cross-asset class framework that includes uniform models for front office and risk. So let me pause here for Sakvir's conclusion.
Thank you, Dimitri and Vlad, for presenting today's webinar, and thank you all for listening. So I understand there's a few questions that have come in on the question pane, which Dimitri and Vlad will now go through and respond.
So I will take the first question, which is whether using standardized approach, I understand it under FRTB, is a viable strategy. And I have to say I believe so as for the smaller banks. Basically, the IMA implementation is now going to be considerably more complex than it was before, and you can get hit by the standardized charges anyway if you are going to do, if your portfolio is relatively simple and straightforward, looking at whether the SA is a viable alternative should at least be part of your business strategy. I believe there is at least one Australian bank, major Australian bank, considering doing just that. Dmitry, do you want to take a question?
Yes. There is the question, what's the best way for banks who currently use standardized formula to cope with the new regulation? I think we mentioned already that now there will be just two methodologies, BA-CVA and SA-CVA, and I think we showed that SA-CVA is much more attractive. So for banks, we think, which don't have its prime time kind of to implement unified, or to if these XVA functions are scattered, to unify this and to build a CVA engine which will satisfy regulations. We actually heard about some banks which try to build this based on or following these regulations, because will allow to HCVA having the desk, that will allow to use collateralization, and that basically two main strategies which can significantly reduce capital charge, which otherwise can be extremely punitive. Vlad, you want to take another question?
Okay. So the question is, what are the issues that face organizations with multiple regulators? Well, that's a good question, because so far there has been only one draft on November last year. And even from that draft, you can see that there are small but important differences from the BCBS draft. For example, special buckets for covered bonds issued by European Union entities, which might have some impacts that the European Commission actually didn't consider fully. So it very much remains to be seen how the individual regulators will, or indeed if they will at all, which might be the case for the US with the incoming administration, how they will put in the localization. I believe there will be challenges, because we know that for whoever wants to do business in the European Union will have to go by the EC entity shortly. So people will have to incorporate that version of the European Commission FRTB rules, whatever they are, and you might end up with effectively having to implement 2 or 3 or whatever number of regulators you have versions of FRTB. So will definitely increase, or it will not lower the complexity of your business, and that's going back to the thing that I said, the complexity will cost capital, in this case operational capital.
Okay, I can take another question. I think it looks like a follow-up to the first one. How do you think a new FRTB-CVA framework will affect organizations with already existing XVA desks? For organizations which have XVA desk already in place, we think most important is trial process. So of course, the process of calculating sensitivities or scenarios on very challenging, and here you have to use bucketing, you have to use scenarios which are not part of the regular kind of desk calculation. So there is also calculations which should be done across all asset classes. You have to include, you saw this bucketed, each calculated for its own kind of asset class and so on. So that should be all done in one system. So very important to have unified system, unified database, and very efficient calculation, because that's all contribute to ability to calculate pass for SA-CVA and then to calculate SA-CVA in that's what we think should happen to already existing XVA desks.
Yeah, I'll just follow on that I believe, as I said, that in general data quality, data provenance and so on is going to be much more important for anyone who has to implement FRTB because the standardized approach, be the market risk or the CVA, is going to be much on the data quality that you have, and not just on the market data itself, but also on the various indirect data, if you will, because, for example, under equities buckets on the standardized approach market risk, you have large cap and small cap equities, and they have different risk weights. So you need to monitor where do they fall, and it's, for example, not very clear from the BCBS or from the EC rules how often you should monitor these and how often you need to switch from one to the other. So data quality is a thing for everyone.
Okay, great. I think we've run out of time. Again, thank you, Dimitri and Vlad. For the listeners, just to let you know that we do have a related white paper available on our website. You can go to www.quantifisolutions.com to download a copy. And finally, the short FRTB survey that I mentioned straight after this webinar. Thank you all for listening, and I hope you enjoyed the webinar.